Good afternoon, everyone, and welcome back to Week in Markets here at True Potential. Now, tariffs obviously are dominating market returns this week again, especially in the equity markets. So we're going to make that the focus of our discussion today. I'm delighted to be joined by Sam Elliot, our investment analyst here at True Potential Investments. So, Sam, let's focus first on data because we actually have had some interesting data in the second half of the week. Today, we've had the UK GDP for the month of January. So could you update our viewers and listeners on that print, please?
Yeah, sure. Thanks, Kevin. So we saw that the UK GDP print for January came out today. The economy actually contracted by about 0.1% over the course of January, which was lower than expected. So economists' consensus expectations were for growth of 0.1, so disappointment there. And that really came through within the manufacturing and also the construction sector. So there was weakness in those areas, partly driven by bad weather. So you could maybe expect to see that rebound a little bit in February, but disappointment there. The one area that remains positive in the economy is services, so that was the one area contributing on a positive basis. If you think about that on a year-on-year basis, we saw the economy grow by 1%, but actually most of that growth came through in the first couple of months of that one-year period. If you look at the economy relative to where we were in, say, June, it's only grown by about 0.3%. So since the Labour government was elected, we've only actually had four of seven months where the economy's actually contracted.
Yeah, and I think there's a couple of things in there, Sam, that are interesting. That the services being the only part of growth we've had is good for GDP, but of course that's what's bad for inflation because it's services-based inflation which is keeping underlying inflation in the economy at 5%. And also you're probably being too kind with regards to the monthly data on GDP. It's pretty poor. Effectively, the economy hasn't grown since May. In the last 12 months, we've only had 3 months where we've actually had growth, and that's been due to some milder weather, which we were fortunate to have in late winter, early spring last year. So it's pretty grim, actually. And as you pointed out, the manufacturing sector here it's not a huge part of the economy, but it's in a recession. The industrial sector is in recession. The construction sector, not so bad, but it's still not a huge part of the economy, and we're not seeing huge growth there. So we're very much reliant on services there, aren't we?
Yeah, and I think if we look ahead to sort of 2 weeks' time, we've got the spring budget coming up, so it's all pressure on the Chancellor ahead of that.
And no doubt this is already in the OBR's statement and forecasts to the Chancellor, and that's what number 11 Downing Street is probably going to have to factor into the spending restraint and spending cuts, which are likely to be communicated in 2 weeks' time. Okay, so not necessarily the most positive start for the UK. So let's jump into the US, Sam. We had inflation for the month of February this week.
We did, yeah, and more positive news, as you say. So inflation was 0.2% growth month on month. That was lower than expected. I think expectations were 0.3, but also came after January was quite high. So January, the inflation prices grew by 0.5. So it came down since then, and that was actually the slowest increase in prices in the US in 4 months. So that was positive. And also just if you exclude the most volatile measures of inflation, so things like food, things like energy, that was also 0.2 and also less than expected.
Not anywhere low enough to think the Fed would cut rates, though.
No, I think that's right, yeah. Obviously there's a lot of uncertainty at the minute. We've heard the rhetoric from the Fed being that they're on hold, essentially wait and see until some of that uncertainty clears. If you just look at some of the components which were driving that lower, I think there was falls in prices for cars, for gas prices, and also for airfares as well. On the more positive side or the higher side, it was the housing component continues to be the area that's driving inflation, but that did slow from the previous month.
And I think, this is interesting because inflation is going to be a bit of a challenge for us here in the UK over the rest of the year. It's not really a challenge or a worry for policymakers in the US. As you said, CPI 2.8 is now below 3% again. And we know that core PCE, this core measure the Fed prefers to look at, is also 2.8. Albeit that's only for January, but these numbers comfortably have fallen from their peak and are remaining fairly benign in around 3%. So that's enough for the Federal Reserve to be, I guess, on hold for now and having cut by 100 basis points at the end of last year. They're likely just want to see how that filters through into the real economy. So let's then, I guess, tie it all together, the growth numbers in the UK, inflation in the US, bond markets.
Yeah, I think that's right. So bond markets have been on the rise in terms of yields over the course of 2025 so far. We see that most notably in Germany. We obviously had the announcement or the news a week or two ago just around increased spending, and we saw yields increase by about 0.5% since that came through. But that's also been reflected across broader Europe as well. So you saw similar rises in yields in the likes of France and Italy. So really, the bond market's saying that nominal economic growth is actually going to be quite strong.
And more broadly, so we've seen yields rise not just in Europe, but we've also seen yields rise in Chinese sovereign bonds as well, Japanese government bonds, and even the UK. So I think that is that this idea, Sam, that you said, that markets do appear to be pricing higher nominal growth in the rest of the world. And of course, bond yields have fallen in the US. Perhaps they're pricing lower growth there as a result of tariffs, which is a neat segue into the final part of our discussion today. I think it's fair to say it's more tariff noise. It's an escalation, particularly from Canada. What are your thoughts and comments on it?
Yeah, like you say, it's a lot of noise. The news is changing every day. There's tariffs on, there's tariffs off. We saw that with the likes of Colombia. But think about what countries are either receiving tariffs or have the threat of tariffs. It's China, it's Canada, it's Mexico, it's parts of Europe, India, Japan. So it covers a lot of the
It's a
global
huge amount
GDP.
of world GDP. That's just the challenge. I think if Trump wants to negotiate deals, he's going to be doing a lot of negotiating with a lot of major economies. So I'm not quite convinced that he's after deals if he's spreading his tariff envy or his tariff ire, so wide so quickly. Perhaps he's looking after small wins. Mainly, I'm not quite sure what he wants from Canada, for example, but certainly he seems to want. He could do with something, and I guess the economies could do with something with Trump resolving one of these issues quite quick. And of course, that's just what feeding into equity markets, which is we've seen falls not just in the US this week, but also in other global markets as well.
Yeah, that's right. Yeah.
And the one market that's has performed well, somewhat bizarrely, is China. Chinese domestic stocks up on the week and also up on the month. So I think in summary, it's pretty clear that the tariff noise is going to continue, but markets have adjusted. Equity markets have fallen. The US is down around about 5.5% this year. We're still seeing positive year-to-date returns from UK and European stock markets as they price higher nominal earnings from corporates. And that leads us back to the UK. So please join us next week where we'll focus in on the UK again because we have employment data for the UK and then CPI. And these will be the last major economic prints before the Chancellor's spring budget update the week after that. So thank you for tuning in. Please enjoy your weekend and we'll catch up with you next week.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value and you may get back less than you invest.